Okay, so the moment you say that, we're going to get a 700-point drop in the Dow.
Oh, probably more than that.
Probably more than
drop
that.
A lot more than that.
You're okay with that as Fed chair? Like, hypothetically, I mean, wouldn't that just have a huge ripple effect on the entire economy if the wealth effect holds? Yeah. Pleased to welcome back to the show esteemed economist, chief market strategist Peter Schiff, host of the Peter Schiff Show. You can check out his show, link down below. He's got a great following, and he's been actually, Peter, you've been talking on your show about the markets, valuations getting completely out of control, why Japan could be the next trigger flashpoint for a U.S. crisis. We'll talk about that. You have some thoughts on the FOMC. You have some thoughts on the crypto markets, perhaps being a leading indicator. And gold and silver, I'm going to get your thoughts on that as well. The pullback that we've seen since the end of February. I had you on earlier in the year in January. And so this was right before, last time you were on the show, it was right before silver and gold peak. So we have a great agenda today. Welcome back. Good to see you.
Nice to see you too, David.
Yeah, on your show, which I encourage people to check out, Peter Schiff Show. You got a radio show as well. But on your show recently, you've been talking about the meltdown. Okay, so the title of the video is "The Meltdown is Coming." Great title. And in it, you've been talking about SpaceX IPO being an indicator of how frothy the markets are going to get. I'll let you comment on why you think there's going to be a market meltdown. I mean, so far, we've seen the complete opposite of a market meltdown, but something's brewing. What is it, Peter?
Well, it's been melting up. Eventually, it's got to melt down. But yes, I mean, the valuations are at extremes that have never existed before. I mean, we've had excess valuations, and they've always ended the same way with a major decline. This time, the valuations are even more extreme than they've been at prior peaks. And that doesn't mean that we can't go any higher. I mean, obviously we can. But the question is, how much room is really there left to go before the whole thing implodes? I thought the SpaceX IPO was potentially a bell ringer. Hey, this is peak insanity with a company trading at over 100 times a revenue of this size. I mean, yeah, maybe you can have a small biotech company that really doesn't have any revenue. But a major company with a $1 trillion plus market cap trading at over 100 times revenue. And, they only sold about 4% of the company in the IPO, even though it was a record-breaking IPO in how much money they raised. They barely sold any stock. So we're determining the price of all the shares based on the 4% that are available to trade. So it really allows for an excess valuation. But I think what's a really good harbinger of what's going to happen with these bubbles that have really yet to pop, or maybe have, but we just can't tell yet, is what's happening in crypto. Because that was really the peak of the bubble. That was the most insane part of the bubble was crypto. Because, AI stocks, they at least have some underlying value. We can argue over how much they're worth, but they're worth something. I mean, they're viable businesses. The question is, what do you pay for those businesses? What is the present value of their future earnings? But Bitcoin and most of crypto, I mean, they have no earnings. They have nothing. They have no underlying value. It's all just hype. It's all greater fool. And that bubble has already popped. And Bitcoin, which peaked at 126,000, is down at around 64,000. So it's down about 50%. But Bitcoin is lower than it was in April of 2021. So for 5 years, Bitcoin's gone nowhere. Meanwhile, strategy stock, the poster boy, the big buyer of Bitcoin and the creator of so-called digital credit, which is really an oxymoron, but that whole thing is imploding before our eyes. Strategy is now down, 70%. It's trading at a 25 to a 30% discount now to the value of the Bitcoin per share. Yet Saylor keeps liquidating shares to buy more Bitcoin when he should be selling Bitcoin to buy back stock. But he can't sell Bitcoin because he tried to sell 23 Bitcoin and the market's collapsed. So he's sitting on, 800,000 some odd Bitcoin that he can't sell. Mm-hmm. And so he's selling what he can, which are his own shares, despite the fact they're at a massive discount, and stretch his preferred creation that pays 11% is now paying like 12.5% if you buy it, because the shares are trading below 90 when par is 100. And he can't issue those anymore without raising the dividend, which he doesn't want to do. So he's stuck. I think this whole thing is imploding. And once this one goes, it's going to be like dominoes. The Bitcoin bubble and the crypto bubble, and now, more are going to go.
I did ask Michael Saylor about your views on this subject. He says, well, Peter, and I quote his words, Peter is not a lover of anything when it comes to Bitcoin. And so, he's trying to explain he's got a larger strategy here, no pun intended, for strategy, and that involves financing. But, this is not the first time he's sold Bitcoin. And it's probably not going to be the last based on history. Maybe this is just indicative of the cycle of where the market is right now. And it's always recovered in the past. What do you think?
Well, first of all, it makes no sense for him. 3 weeks in a row, Strategy has sold common stock to buy Bitcoin. Why would you do that? I understand the logic when your common stock is trading at a premium. So you can sell stock for, $1.20 and then go buy $1.20's worth of Bitcoin and increase your Bitcoin per share. But if you're going to sell your stock for 80 cents and then go out and only have 80 cents to buy Bitcoin, and you're going to lose Bitcoin per share, what is the point? He was always stressing the Bitcoin yield. How did he generate Bitcoin yield? By selling stock at a premium and then taking the excess and buying more Bitcoin. But now he's selling stock at a discount and he's destroying Bitcoin per share. He's got a negative yield now. Why do that? What is the purpose of doing that? The only purpose is so he can keep buying Bitcoin to prop up the price of Bitcoin. But he has to sacrifice his own shareholders in order to do it. So that's the game over. Mm-hmm. Meanwhile, he's got this huge obligation now to pay all this income, the dividends, to the preferred shareholders. And he keeps having to raise cash by selling stock at a discount again to raise cash to make these payments that he can't afford because he doesn't have any revenue. He doesn't have any income to service all these obligations. So all he can do is liquidate assets in order to pay creditors. I mean, this eventually the whole company collapses. I mean, regardless of what you think about Bitcoin, Strategy is a disaster.
If you're watching markets move in real time and thinking about how to act on these movements, well, today's sponsor, Plus 500, is built exactly for you. It's a futures trading platform regulated by the CFTC and NFA in the US and listed on the London Stock Exchange. You can trade across crypto, forex, indices, energy, metals, and agriculture, all from one interface. What stands out is speed and control. You get live price feeds, built-in technical indicators, and proper risk tools like stop loss and take profit, so you're not flying blind when positions move fast. And if you're not ready to put money on the line yet, there's a free demo account where you can test strategies in real market conditions without any risk. Scan the QR code on the screen here or use the link in the description down below, and you can get $30 off when depositing $300. Terms and conditions apply.
Okay, I'll let maybe one day you and Michael to sit down face to face. Maybe one day.
You won't get him to agree to that. A lot of people have tried to get us into a debate. He refuses everybody.
Okay.
He won't engage me.
Well, that's too bad. For now, let's go back to the markets. I've noticed, by the way, the DXY has been strengthening, while dollar alternative assets, if you want to call them that, gold and Bitcoin alike, have both been falling. So maybe this isn't just a crypto story, it's a rotation into the dollar story. What do you think?
Yeah, look, there certainly was a bit of a bid in the dollar regarding the Iran war, which I think we lost.
Why did we lose, by the way? I'll go back to the dollar, but just because you said that, why did the U.S. lose the Iran war?
Well, I think we lost the war for the same reasons that I said we would lose it the day that we declared it. We didn't achieve our objectives. We did not change the Iranian regime. They're still in power. Yes, we killed some of them, but the people that replaced them are the same, cut from the same cloth. They may even be more radical and more extreme. Who knows? But we didn't really denuclearize Iran. We're basically acknowledging that they're going to continue to enrich uranium and have nuclear so long as they don't use it for weapons. But that was exactly the position that we were in before the war. The Iranians never said that their goal is to have a nuclear bomb. They just said they needed a nuclear to have power. And we just didn't take their word for it. And now all of a sudden we trust them. So we haven't really achieved anything. We wasted a lot of money. We blew up a lot of our missiles and bombs that now I guess we have to replace. But in order to get this deal, we had to make a lot of concessions to Iran. We had to agree now that we'd waive the sanctions and they could sell their oil. We have to agree to return to them, even as part of the MOU, billions of assets that we had frozen. And we're working to arrange, assuming that we get a final deal, a $300 billion investment fund to invest in Iran. And ultimately, Iran is going to be able to decide what kind of fees it wants to charge ships that end up passing through the Strait of Hormuz, where before the war, it was getting nothing. So I think Iran wins simply because it survived. We threatened to get rid of the regime, and the regime is still standing. And they signed a deal that economically empowers them, that enriches them. Yes, we did diminish their military capabilities as far as conventional weapons are concerned. But that military was never a threat to America. Their ships, their planes, their missiles, they were never going to target the U.S. mainland. So to the extent that maybe he's less of a menace in the Middle East, that may be a benefit to some Middle Eastern countries, but I don't see the direct benefit to the United States. But meanwhile, Iran is going to have a lot of money now from investment capital, from oil sales, from fees on the Strait to rebuild whatever it wants of its military. We have no restrictions on what they can spend their money on. They can do whatever they want with it. And we don't have, now they're talking about maybe having some inspections, but they haven't even agreed to that yet. So far, it's just we have to just trust the Iranians, which is the exact position that we were in before. So I think Trump made a mistake in declaring the war. And then once he realized that he couldn't win, he tried to figure out how to get out of it, how to surrender and pretend to win, which is really, what Trump does anyway. Everything is pretend. Everything is make-believe. We have a lousy economy. Just claim we have the greatest economy in the history of the world. Right? Mm-hmm. Just pretend everything you do is the best and the greatest, no matter what the reality happens to be. And, that's part of, we talk about why the dollar is going up, because you have Kevin Warsh, pretending that he's going to fight inflation, that he's determined to restore price stability, that he's, going to succeed where his predecessors failed. And that's all a bunch of talk. He admitted that inflation is a choice. And it is. We choose inflation. Powell chose inflation. Yellen chose inflation. Bernanke, Alan Greenspan, who just died, he wrote the playbook, choosing inflation. And Warsh is going to make the same choice for the same reasons. Because if you choose not to have inflation, then you choose a massive recession, a huge drop in stocks, in real estate, in bonds. Maybe you choose a financial crisis. You choose to force fiscal responsibility on the government. But he's not going to choose that for the same reason nobody has chosen that. The government is about 50% bigger now than it was before COVID. It's spending 50% more money. We're spending like $7.5 trillion a year, but we're barely collecting $5 trillion a year in taxes. Where's that extra money coming from? It's debt, and it's being monetized. And if the Fed doesn't create that debt, that there's no way that the government can service it. So we're going to have inflation because that's how we pay for government. And the Fed is going to enable it under Walsh, just the way it's enabled it under his predecessors. The gold market, the silver market, don't get that yet. They will.
Yeah. I'm going to come back to all of those points, very important points, but just in the fact that the Iran war has been lost strategically, take a look at this. The U.S. exports about 30% of the energy it produced, and this has grown in recent years. This is from the EIA as of 2024. My point is, Peter, do you think the U.S. energy industry is the hidden winner from all of this, given that the Strait of Hormuz is closed, and then now the U.S. is benefiting because They're not a net exporter, but they still export a lot of the crude.
Yeah, look, I think oil companies are in a good position. I mean, I own stock in some U.S. oil companies. I think higher oil prices are good for oil companies. And I think one of the results of the war is going to be higher oil prices. And so that's going to benefit oil companies. I think oil prices were going to go up anyway. They're just going to go up even more in the premium that's going to exist in crude for quite some time now, because there's so much uncertainty. We have no idea, that strait can close back down at any moment. Meanwhile, look at our strategic petroleum reserves. They're at the lowest they've ever been. And other countries have also sold down their reserves. So I think you have a lot of demand now to replenish depleted reserves. That will just add to energy demand. And there's a lot of energy demand. Look at all the this hyperscalers and this big build out in the data centers. There's tremendous demand for energy right now. And that's going to push up oil prices. So sure, oil companies are going to benefit. I don't think overall American economy is going to benefit, even if we are a net exporter of oil, because the benefits of higher oil are concentrated, in the oil companies and the people who own stock in the oil companies. But the majority of Americans don't produce oil. They don't have oil rigs in their backyard. They buy oil, and they don't work for oil companies. I mean, how many people do oil companies employ in America? It's not that big. So most Americans are going to suffer higher oil prices. They're not going to be among the few who benefit from it.
Well, you've been calling for higher inflation for quite some time on my show in the last year. You've been right. I mean, inflation is higher now. So the question is, what's going to happen to the economy once interest rates go up? Now, you've argued that the interest cost is going to explode, which is going to put a lot of pressure on the deficit, which is going to put a lot of stress on the U.S. dollar. And I wonder why. My question is for now, I wonder why the U.S. dollar is still behaving the way it is, which is going up, despite the fact that we have the threat of higher rates potentially making investors lose confidence in the dollar.
Well, it's gone up, but it's not gone up a lot. I mean, it's barely above 100. It's not even 101. So it's not like it's exploded. Dollar index is not 120. And one of the reasons it's gone up is because the yen is so weak. I mean, look at the yen is breaking down about 162. And that is a yen weakness story. It's not a dollar strength story. But I think as some money is moving out of the yen, right, it's moving into the dollar. But overall, I think that the dollar is going to weaken because traders are focused more on nominal rates. The Fed is going to hike rates. They've gone from forecasting rate cuts to now 2 or 3 more hikes between now and the end of the year. But these are quarter point rate hikes. 75 basis point hike is not going to do anything to slow the inflation train. It's way too far ahead. It's going too fast. That's too little too late. I pay attention to real interest rates, and real interest rates have already collapsed as inflation has accelerated and the Fed has just stayed still. And so I think the markets are going to start to focus on that, not to be fooled by a nominal payment when it's a fraction of what you're losing in purchasing power to inflation. And so rather than buying dollars to get that nominal yield that is actually a negative yield, investors will be buying gold to avoid that loss.
The Japan story, let's talk about that. That's important. Yeah, the yen is at 160, 161.
162.
Yeah, 162. Wow, okay, I'm behind. Okay.
Yeah, it was like 161 and a half to 160. Yeah.
That's a key trigger point you mentioned. And how does this impact the U.S. investor and economy ultimately?
Well, first of all, Japan is sitting on over $1 trillion of treasuries.
That's right.
And if they're in a financial, position, a difficulty where they need to pay down debt and raise cash, an obvious source is the U.S. Treasury market. They have this big pile of U.S. Treasuries that they can liquidate. So that immediately impacts us. But also, as the yen is, that puts upward pressure on interest rates in Japan. I mean, year over year, import prices in Japan are already up 25%. And, that's a big deal. And now it's going to go up even more as the yen weakens, by definition, everything costs them more. And so as the yen weakens and inflation accelerates, that puts more pressure on yields in Japan, which now, if you look at the 30-year yield, it's almost 4%, like 3.8. A couple years ago, it was less than 1. And the 10-year bond, which is yielding, what is it, like 2.6, 2.7? That was 10 basis points a couple of years ago. And it was 10 basis points, I think, from like 2017 to 2022. I mean, almost zero. The Japanese government was borrowing at close to zero on 10-year paper. But now, with 2.7%. But as that yield rises, it becomes a competition for treasury yields. And, not just, all these sovereigns compete. The Japanese government's borrowing, European governments are borrowing. The U.S. government is borrowing, right? So all this competes. So as yields go up there, it's going to put upward pressure on our yields. And Japan is running debt to GDP right now. They're running a deficit of about 4.5% of their GDP. That's a lot of debt, especially when they're already at 250% debt to GDP. And they're adding debt as interest rates are soaring. So Japan could find itself in a sovereign debt crisis even sooner than we find ourselves in one. But obviously, if Japan gets into a crisis, that is a problem for us too.
People have actually looked at Japan as a model for higher debt deficits, 250% debt to GDP. So the U.S. is nowhere near 250%. But people look at Japan and say, well, look, the economy hasn't completely collapsed. It hasn't recovered since the late 80s and early 90s. But we can go up to Japan's level and everything will be fine. What do you say to that?
Well, first of all, I don't think everything is fine in Japan. I think there's going to be a big problem. Okay. But just because Japan could get to 250% doesn't mean that we can, because there are some other key differences. Japan is still a creditor nation. That means that the Japanese own more foreign assets and foreign debt than foreigners own in Japan. Almost all the Japanese government debt is held by the Japanese. They don't owe it to the Europeans. They don't owe it to us. Whereas in America, we're the world's largest debtor nation. We owe more money than all the other debtor nations combined. So we have an external drain. So when we pay interest, we don't pay it to ourselves. We pay some of it to ourselves, but a lot of it we pay abroad. Japan pays almost everything to itself. Japan also has balanced trade. They have a surplus some year deficit. We have over $1 trillion a year trade deficit. So we don't just have to finance budget deficits. We have to finance trade deficits. And our GDP is much more heavily concentrated in the service sector. The biggest employers in Japan are still manufacturers. The biggest employers in America are FedEx, UPS, Amazon, and Walmart. They don't produce anything. All they do is sell shit and transport it around. But the stuff they're selling and transporting were made in foreign countries. So our GDP is a lot of fluff. So I don't think we have anywhere near the run room that Japan had. I think they had a lot more rope to hang themselves with than we do. But they're still going to end up dangling on that rope. We're going to dangle on a shorter rope because we can't get to 250%. There's just no way that it's going to get that big here. But the other thing that we have that they don't, we have the reserve currency. So that's bought us some time. That's the only reason I think it's gone on as long as it has.
But at what point would Japan be forced to sell U.S. treasuries?
I don't know. I mean, I guess they're never forced to. They could keep printing money and destroy the yen. But to me, they need to sell their U.S. treasuries and pay down debt. But even if they sold all of their foreign exchange reserves, they can only pay down about 15% of their debt. So they'd still have a big problem. But at least they can make a dent in it. It makes no sense to just hold on to that and keep selling, printing more yen and issuing more Japanese government bonds when you have this pile of treasuries you can get rid of.
So bring it back to home, the Fed has to raise interest rates to combat inflation, but they can't raise it too much, whereas the bond market's going to break and the economy is going to crack. So well, it's
not just raise interest rates.
Yeah.
They got to if they don't keep printing money, the balance sheet is still expanding. Look at what's going on. They have to keep buying bonds. They have to keep doing quantitative easing. Because if they don't buy these bonds, who will?
I think that might be the key difference between Warsh and Powell. This is just my take. I don't know if I'm wrong. But remember how Warsh back in 2011 protested against QE and he left? Maybe he doesn't like this.
It. Yes.
It wasn't brought up at the last FOMC that they're going to shrink the balance sheet. But do you think that's his next move?
No, he can't shrink the balance sheet. He's going to expand the balance sheet. In fact, it expanded last week. If he wants to shrink it, why isn't he shrinking it right now? In fact, what he's doing is he's setting up a task force to study the problem. Right? He doesn't actually want to solve it because the government is running deficits now of like 3 to 4 trillion a year. If you look at what we're spending versus what we're collecting, where's the government going to get that money? The only source would be the Fed. The Fed is going to have to buy a lot more government debt. And it's going to create money out of thin air. It's going to create inflation in order to do it. Otherwise, long-term interest rates are going to soar. Because if we have to find private buyers, because who's going to buy? Remember, who are the big buyers of treasuries? It was foreign central banks. They're not big buyers. It was U.S. government trust funds. Social Security Trust Fund. Man, they're sellers now. The Social Security Trust Fund sells U.S. treasuries every year. It's not a buyer. It's a seller. So foreign central banks aren't buying. Government trust funds are selling. Who's going to buy? Is the public a big buyer? No, the public's not buying treasuries in a big way. They don't have any money anyway. The average American is broke. They don't have any money for treasuries. But when the average American decides to invest, he doesn't want to invest for 4% yield. They're buying SpaceX. You know, they want to go to the moon. Right? They don't want to clip a 4%, 5% coupon, even if treasuries were 6 or 7%. They don't want that.
Yeah.
So there's just no demand there. The Fed is going to supply it. Now, it shouldn't. The Fed should allow the collapse. The Fed should force the government to cut spending. The government should be cutting Social Security, Medicare, national defense, government pensions, farm subsidies. All this stuff should be cut. And if the Fed refused to buy all this debt, it would be cut. But, the Fed's not going to do that. The Fed is going to cooperate and enable the profligacy, just like it's done, since Greenspan.
Well, what's a more important tool for fighting inflation? The money supply, which is the balance sheet size, or interest rates?
Well, both, actually. I think the money supply, and they kind of go together. But remember, inflation is about an expansion of money and credit. So the reason that prices go up when you have inflation is because there's more money chasing a supply of goods. Well, you can buy goods with credit. You don't need money. I can have no money. I can go into a store and I can buy all kinds of stuff, even though I have no money. I can use credit. And so credit acts like money in an economy. And so inflation is an expansion of money and credit. You get more credit, you get more money, you get higher prices. The Fed is basically controlling that. Controls the money supply, controls the price of credit. And so we've had artificially low interest rates and an expanding balance sheet. That's been the source of our inflation. In order to deflate, we need to shrink the balance sheet and let interest rates go up. But if we do that, the whole house of cards that was erected on top of all that cheap money is going to come crashing down.
So,
and that's what nobody wants. Like Donald Trump, when you talk to Donald Trump about housing, he says he wants housing prices to keep rising, even though they're already unaffordable. And first-time home buyers are now 40 years old because that's how old they have to be before they can afford to overpay for a house. Donald Trump wants houses to get more expensive because he wants the older people to stay rich or to feel rich. He wants people who bought their homes 20, 30 years ago at a much lower price to stay rich on paper. And he doesn't want the prices to come down. Well, if mortgage rates go up to 8, 10%, 12%, I mean, they have to come crashing down. And that's where they would go. They would probably go higher than that if the Fed did the right thing.
This is actually what he said. So this is you're right. I just pulled this up as you were mentioning this.
God said though is again, existing housing, people that own their homes, we're going to keep them wealthy. We're going to keep those prices up. We're not going to destroy the value of their homes so that somebody that didn't work very hard can buy a home. We're going to make it easier to buy. We're going to get interest rates down. But I want to protect the people that for the first time in their lives feel good about themselves. They feel like they've...
How's he going to do that? He's gonna make it more affordable for people to buy homes, but also stop people from owning homes to have their wealth collapse.
Well, he wants to make it easier to overpay for homes by getting mortgage rates down, so you can borrow more money to overpay for a house instead of letting the house price come back down. See, he wants people who are benefiting from a bubble. There's a housing bubble, and he's like, I don't want the housing bubble to pop because then the people who are benefiting from the bubble won't be as rich.
That's right.
They never should have been this rich. And it's all on paper. What is a house worth that you can't sell? Because ultimately, the house is worth what the buyer can afford to pay. And if you want to pretend your house is worth $1 million, but the highest offer you've ever got was $700,000, your house ain't worth $1 million. I don't care what you think it's worth. If you can't sell it for $1 million, it's not worth $1 million.
Is he right, though? It's not just houses. The wealthy people own stocks. If the market collapses, if the housing market collapses, we go into a recession. So maybe he's got a point there?
Well, he's got a point. The solution involves bursting a lot of bubbles. And so asset prices have to come down. But since he doesn't want asset prices to come down, goods prices are going to go up instead. And so real asset prices are going to fall no matter what the president does. But he can keep asset prices propped up if he has the help of the Fed. But then consumer prices go up. So instead of your house losing half its value, everything you want to buy doubles. And so it seems like your house has lost half its value because, everything is twice as expensive and your house stayed the same, right? So, but they can't create real wealth out of thin air. Yeah, they could play around with the numbers by creating inflation. And they can make people feel that they're richer. Oh, look, I have $1 million house. Okay, you have $1 million house, but you have a $10,000 box of cereal in the pantry. What is that $1 million house worth?
What would you do? Let's say Trump invites you to be the next Fed chair. He says, Peter Schiff, you've got Kevin Warsh's job. I mean, you're in a quandary here, right? You can't raise interest rates too high.
Well, he already crash markets. He already called me a loser and an idiot. So I don't think he's going to appoint me. But look, if I was chairman of the Federal Reserve, the buck would stop with me. I mean, I would basically, let everybody know the Fed is no longer in the business of monetizing government debt. There is no Fed put in the market. If the market drops, the market drops.
Okay, so the moment you say that, we're going to get a 700-point drop in the Dow.
Oh, probably more than that.
Probably more than
drop
that.
A lot more than that.
You're okay with that as Fed chair? Like hypothetically, I mean, wouldn't that just have a huge ripple effect on the entire economy if the wealth effect holds?
Yeah. Well, yeah. Well, it's like, do I want to rip the Band-Aid off or do I want to peel it off slowly? Yeah, look, I want to get it over with. I know it's going to be bad. It's just going to be worse if we don't do it. And had we done it my way, had they made me Fed chair 20 years ago and I would have done the right thing, we would be in great shape right now. And it wouldn't have been as painful to do it 20 years ago as it's going to be to do it now. But that doesn't mean you don't do it.
Alan Greenspan passed away. Alan Greenspan passed away today. What was his legacy?
Well, he wrote the playbook that everybody is following. I mean, he was the architect of the House of Cards that collapsed in 2008. I blamed him for the 2008 financial crisis years before the crisis happened because I knew that his policy mistakes were setting us up for that crisis. And it blew up on Bernanke, but Greenspan created the problem. And I knew it, and I described it for years before it blew up. But then Bernanke, then Yellen, then Powell all followed the Greenspan playbook to kick the can down the road and keep interest rates artificially low. And, they expanded the balance sheet and put us in this situation that we're in today. I mean, a real crash, which was the topic of one of my books, you can see on my desk there. But the real crash is coming, and it's because of Greenspan and the playbook that he wrote that every predecessor, and I believe it will include Warsh, are going to follow.
Going back to markets, we'll finish off in the last segment here. You once told the media you'd be a lot richer if you had invested all your money in the Max 7 a decade ago. Well, that was a decade ago. We can't turn back time. What are you doing for the next decade? If the Max 7 did this well in the last decade, I mean, it's not too late, Peter. Would you rotate now?
Yeah, that's like, I would be a lot richer if 15 years ago I put all my money in Bitcoin. I didn't do that either.
Sure.
But that doesn't mean I'm going to do it now or even a few years ago, because Bitcoin is, lower now than it was 4 or 5 years ago. So I was wrong from a, trader's position. I don't think I've ever been wrong on Bitcoin in my fundamental understanding of it. But as a trader, yeah, I could have made a great trade. I could have bought some of this crap 15 years ago and sold it 5 years ago, and I made a fortune. I didn't do that. And I didn't do, the same thing with, obviously a lot of these AI stocks. Now, I own a couple of them. I own some. I have a stock I'm up almost 100x in. I mean, I think it may be 100x. So I've got some money. But when I bought this stock, I didn't even know it was an AI stock. I mean, it wasn't when I bought it. It kind of became one. Yeah. And so I got a little taste of it. But yeah, I mean, obviously I could have made a lot more had I put a more substantial percentage of the portfolio into these names. But I'm more of a value investor. I'm not buying into hype, and I'm trying to win it, like the tortoise, not the hare, right? I want to win and cross the finish line. I don't want to run out of breath and drop dead. Having the lead, most of the way, and then I don't make it. So I'm still buying what I've been buying, which is precious metals, mining stocks, commodity stocks in general, energy, agriculture, emerging markets, value, dividend-paying companies, foreign stocks. And, I had a great year last year. Best year I've had in, I don't know, maybe my career on the long side.
Yeah,
and
sure.
I think that was a breakout year. And, a bit of a pullback. Still, I think we're still beating the U.S. market year to date with international stocks. Gold stocks, though, are now negative, but not much. But I think they're going to end up beating the S&P on the year. I think they'll end up beating the NASDAQ on the year, too. So we'll see how the rest of the year plays out. But it's not quite half over yet.
We have to bring up gold and silver then, since you brought it up. The GDX is still up from 1 year ago, even though it is down on the year.
I'm talking about calendar year, yeah,
exactly. From 12 months ago, calendar year, it is down. Why is the sentiment in gold and miners so low right now? I've talked to a lot of people, and if you look at, if you just zoom out over the last 7 to 8 to 12 months, it's done quite well. It's just a bit of a pullback from this really euphoric period here. What's been going on? Yeah.
Poor sentiment has defined the entirety of the bull market. Right? I mean, investors were never excited about the mining stocks because they never believed the rally in gold and silver. And I think what's really caused this sentiment to get negative, not just the new idea that we have a hawkish Fed that's going to, come out swinging with these rate hikes, but the fact that gold went down during the war is leading a lot of people to question whether or not gold is even a safe haven anymore. Like, hey, why did it go down? Why didn't it go up? And they overlooked the fact that it went up so much before the war. It already priced the war in before the war happened. And by the time the war happened, it was to buy the rumor, sell the fact. Plus, gold was so overbought going into the war. I believe had we started the war and gold was still around 3,000 and silver was still around 30, both would have gone way up during the war. The only reason they didn't, the only reason they came down was because they went up so much right before the war started. But that's created a lot of false negative sentiment on the metals that, hey, they don't work anymore. And a lot of the gold enthusiasm over the past decade was stolen by crypto and Bitcoin. And that's where all the action was. That's where all the hype was, all the Wall Street money, all the political clout was being concentrated on Bitcoin, and that stole a lot of gold's thunder. But I think as the air really comes out of this Bitcoin bubble, and it's coming out, it's just going to come out faster, and more people are going to recognize it. Right now, your typical Bitcoin guy is like a deer in a headlight. He doesn't even realize what's coming. He's just frozen. But they're all going to get hit by a Mack truck. And that's going to take the spotlight off of Bitcoin and put it right back on gold where it belongs. And I think to the extent that crypto is going to be a part of it, it's going to be about tokenized gold. Gold is the future of blockchain, not Bitcoin. Instead of making gold obsolete, blockchain makes gold better. It makes it more fungible, more divisible, more portable. It makes gold better money. Bitcoin was never money. Even though it was on a blockchain, it wasn't money. Gold's been money, but now when you tokenize it, it becomes even better money. It does everything that Bitcoin promises to do, but can't.
Yeah, but even the World Gold Council is participating in exactly this, by the way. I spoke to David Tate at the Consensus Miami conference. Okay, so final question. Interest rates go up this year. Suppose the Fed raises rates. What is the biggest thing to re-rate? In other words, if markets move, what moves the most?
Well, I think when the Fed starts to raise rates, I would expect gold to go up. Just buy the rumor, sell the fact. Everybody knows they're going to raise rates, so get it over with. Because once they start raising rates, the focus will be that it's not enough and that it's going to weaken the economy, and that's going to create bigger budget deficits, and that's going to be good for gold. So I think by the time we do get a rate cut, gold's going to go up. But we may not get a rate cut because between now and the first rate cut, we could have a big drop in the stock market. We could get some really negative economic data. We can get some very weak jobs reports. And then that takes the rate hikes off the table. And that's really going to send gold through the roof.
Interesting. Thank you so much. Appreciate your time. Where can we learn from you, follow you?
Well, don't forget to watch my podcast. Listen to my podcast. I do 1 or 2 a week on schiffradio.com. But the best place to watch them is on my YouTube channel because they're all done live with video. So if you want to, get the whole experience, you can see me. Then go to my YouTube channel and subscribe. Got over 625,000 subscribers now, and so when you subscribe, you'll get a notification every time I premiere a new podcast. And follow me on social media. I mean, I'm on all the platforms. I'm on TikTok. I'm on Instagram. I'm on Facebook. I am the most prolific on X. I'm constantly, there's not a day goes by really that I don't post something. And I'm constantly.
Do you post yourself, or you have an AI agent working for you now?
No. I'm still posting myself.
Okay.
I mean, sometimes people post some stuff. They retweet stuff. I don't do that, or some people, but pretty much you could tell it's me when I come in there. But I talk about politics. I talk about economics. I talk about the markets. I've got over 1.5 million followers now, so that's the way to go. And I'm gaining about 4,000 or 5,000 followers a week now, so it's gaining some momentum. And and so I follow me there and tell your friends to follow me, because there's so much bad information out there and misinformation. I got to counter it. I got to get the truth out there because the lies are all over the place. But at least I don't know if the playing field is level, but I'm on the field, right? I'm there. I get an opportunity. I don't need a network television or cable television. I can go directly to the people with my information. And the more people who get information from me, the more people will see the information. So I get a bigger soapbox, the more people who follow me.
Okay. All right. Well, thank you. We'll put the links down below. Follow Peter Schiff there.
All right, Dave.
Take care for now,
care.
Peter. All right.
Bye-bye.
Thank you for watching. Don't forget to like, subscribe.